Hello, everybody. If this is your first time tuning in to Tim's Tidbit, I like to say welcome. If it's not your first time tuning in, I still want to say welcome and give you a hearty well thank you for always pulling up to Tim's Tidbit. And this is another episode of Mama, I Want to Trade. Welcome. And again, thank you for tuning in to Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rogers Sr. I get on Al Gore's internet and I discuss my thoughts or opinion about the price action, if you will. But that's not what this series is about. This series, as you know, is about the ICT concepts that I trade, and this is just my interpretation of those concepts. Right now, we are in the lingo phase, the lingo playlist, if you will. And the first thing we're going to get into is, drum roll please, the mitigation block. And before I get into the mitigation block, I can't remember if I said it in the overview video, but PD array is what ICT call his different areas of interest, if you will. I think it stands for premium and discount arrays. Sometimes I call them PDAs. But anyway, it is what it is. The first PDA we're talking about is the mitigation block. And Tim, what is a mitigation block? Well, I'm going to give it to you the way ICT give it to you. And then I'm going to give it to you the way that little Timmy Rogers, the voice in my head, understands it. So basically, the mitigation block, first thing you want to remember about the mitigation block is that the mitigation block is not an imbalance. Some PD arrays are imbalances, meaning there's an imbalance in price. Something didn't happen in price that the algos like. And some PD arrays are reference points. The mitigation block is one of those reference points. As you see, it's a resistance or support level, or a bearish or bullish institutional reference point, right? And I say resistance and or support because it can go both ways. You can have a bullish mitigation block or a bearish mitigation block. Everything that we're talking about, it can be bullish or bearish. I may show you the bullish, I may show you the bearish, but all you got to do is flip it on its head to understand the opposite, right? So the mitigation block, right? Let's get into what ICT says. This is ICT straight off of his slide. It's a little confusion. If you want the full ICT blown version, feel free to look at his video in his 2016 core content video. He just uploaded them this year. All of his old paid mentorship is free now on, and just look for the video that covers mitigation blocks and it'll give you the full glory of it. But here is the chunk, the meat and potatoes of what the mitigation block is, right? The mitigation block, again, it's a reference point. As you see, resistance level or anticipated bearish institutional reference point, right? So it's a resistance level or an anticipated bearish institutional reference point. It can also, on the flip side, it can be a support level or an anticipated bullish institutional reference point. There's your drinking word. Remember I said you have imbalances and you have reference points. The mitigation, the first of the reference points that's up to bet, if you will, right? Let's read what ICT says, right? When price action returns to the A point of reference, the long positions taken from A to B from the A to B price swing will have an opportunity to liquidate or mitigate. That's where the name comes from. The net loss that occurred when price dropped from B to C. This can result in a new lower price swing to C for retesting or significantly lower prices into the support level under market price. So excuse me for hitting the mic. So what all that said is when price comes down to this point A right here at this low and it rallies up to B, right? If it rallies up to B, anybody that went long at A from A to B is now in trouble because the market broke down and made a lower low. than where they went long at. They went long between A and B. So now the market went lower and now they're in trouble. They're underwater. So when the price comes back to this breaking market structure right here at point A, now they get a chance to liquidate or mitigate their losses. Like he said, when price returns to the A point of reference, meaning when price returns from here back up to there, that's when they can get out of those shorts that they was in. I mean, those long positions that they was in, because they're now underwater, right? And just flip it on his head if you're talking about the other side, right? If you're talking about people that went short, then they would, if it came back down to the A point, then they can get out of those short positions if they was coming back down to the A point. Just flip it on its head. It's simple enough. You'll get the gist of it when we start talking about it later and actual finding it in price action. But for now, when I give the definition, I'm only showing the example for one side of it, right? So now let's see how little Timmy Rogers understands this, right? This is the way I interpret it, right? Price sets a high, pulls back and makes a low, rallies, but the high at the next point doesn't break the high of A. The breaking market structure qualifies the B to C price leg as the mitigation block. The last down close candle at the low of B is your entry point. Well, Tim, that sounds confusing to me too. I'm glad you said that, little Timmy Rogers. Let me break it down for you, right? Price goes up and sets a high, right? Once you set that high right here at point A, price will pull back and make a low, right? Once you start to rally from that low, the high that you make at C will not break the high that you made at A. Remember, that's the key. The high that you make at C does not break the high that you make at A. When now you want to see heavy distribution coming from C, a heavy drop, like big money dropping from C on down, right? And get a breaking market structure right here. Once you get that breaking market structure, right, from this area down here, you want price to come back up into this. You're looking for the last down close candle to go short off of, meaning, right, when price comes back up to the breaking market structure after this high does not break that high, you come down and you break through that low, and then you enter on the last down close candle on this leg, right? That's when you go short over here. Now, I know it sounds foreign to you. Don't fret. It's going to get easier, especially when we move into the reading price action section for this right here. It'll be much clearer. Right now, we're just identifying the lingo. What is a mitigation block? Remember. Now, let's go find it in price action, right? So in price action, this is what it looked like with the candles, right? Price comes up, right? And we set a high right here at A. See this swing high right here? This green candle, that green candle, that red candle. That's a swing high right there. We'll get into swing highs later, right? We get heavy distribution down, right? And we set a low right here. We have this low right here, right? We come back up and we make a high, but this high does not trade through or break that high. Then we get heavy distribution. See the heavy distribution? That's what I like to see. The heavy distribution, meaning big institutional money moving the market heavily, right? Once the market trades back up, here's your breaking structure right there. We break structure, keep going down. Once the market trades back up to that breaking structure, you're looking for it to come back to the last down close candle. We look for it to come to the last down close candle of this price leg right here. When market hits that last down close candle, you see it trades off. That's your entry point right there once it comes back to this down close candle. So that's your mitigation block. That's how it looks in price action. Again, just a quick overview of what a mitigation block is. A mitigation block is just a reference point where the algos say, hey, I got to go back to that point. The breadcrumbs, as I like to call it. The reference points are breadcrumbs that the algos leave behind. And then you also have imbalances that the algos got to go back to and rebalance. Again, I'd like to thank you for tuning in to Tim's Tidbits. This has been another episode of Mama, I Want to Trade. Hey, hey. Yes. I like this. This was good. This was the first real episode. Please continue to tune in, and I'll see you in the next one. Gone. Yeah.